Hey guys, welcome back. So today we'll be analyzing another business model. I'll be analyzing a company called RACL Geartech, which is an auto ancillary company, right? So we'll be doing this company, and as usual, the order will be the business model. Then we talk about the management commentary, and then of course, Capex, Q4 FY23 numbers, and the FY23 financials. So that is going to be the order. So let us start. I'll just start by sharing my presentation with you. Yeah. Mhm. So yeah, RCL Geartech. First, let us understand what the company does, right? The company does gears primarily, right? That's all, right? Having said that, they do other things also like shafts, spark lock wheels, and etc. But since majority of the revenue is coming from gears, since they're known for gears, we will stick to that, right? Before we go understand the RACL Geartech business model, let us try to understand the auto ancillary industry. Some of you might know, some of you might not know. So I'll just try to cover it, and keep the video as short as possible. So first, let us understand what is this auto ancillary industry. So you all know, right? When you go to when you look at the auto industry, such as Maruti or Tata Motors or any of the auto players you can see, they're not going to manufacture every single component. They're going to assemble your product and give it to you, and your end customer is going to be people like us, right? So that is your auto industry, where your end customer is usually people like us. It is a B2C model. And auto ancillary industry are those. See, for example, when you talk about Maruti or a Tata Motors, like I told you, they won't manufacture everything in house. Maybe for there are so many things that goes, right. For example, in a car, that you need a mirror, you need lights, you need axles, you need shafts, you need wheels or the tires. So as a result, what happens, they will go to other companies that are making this, are known for this. Let's say, for example, if Maruti wants lights, they will go to Lumax. If they want mirrors, they might go to Minda Corporation. If they want lock and key, they can go to Sandar. If they want tires, they can go to Seat or Apollo, or any other tire company. So as a result, auto ancillary companies are those which makes one product or multiple products that goes into the final or the making of your car or a two-wheeler or any other vehicle. This is an auto ancillary industry. And the end customer of auto ancillary industry is who? Other auto companies such as Maruti, Tata Motors, etc. All those things. So it is a B2B model, that is business to business model. Now, an auto ancillary industry is a sandwich business model. What do you mean by sandwich business model? See, for all these components that they're doing, whether it is gears, whether it is axles and shafts and everything, right? You need raw material first to make this product. Now, raw materials, whoever you're sourcing from, they're also another company. Let's say you want to make a product that is comprised of steel. Now you have to go get steel from Tata Steel or JSW Steel or whoever it is. Now that person won't be like, hey, listen, you take my product first and then you can pay me money. That is not going to happen, right? What are they going to do? They're going to first take you have to first give them the money, and then they give you the product. Similarly, once you make the product, you're not going to get the money upfront. It is not a credit business. Like, for example, footwear is a credit business. You as a customer will not get footwear easily. You have to pay the money first, and then you get your product, right? But here what happens is they have to sell their product, wait for the entire cycle, whether it's 2 months or 3 months, whatever the payment period is, and then they get the money, right? And then they get the money. So as a result, what happens? It is a sandwich business model between the supplier and the customer. They're like literally squashed. Okay, that's one thing. The second thing is low bargaining power. Low bargaining power in the sense, like, see, you have to make the raw materials, right? And the raw materials are usually metals, and there will be always this price fluctuation that goes on, right? You know how the the whole metal industry works. As a result, when the Tata Steel ya koi bhi from whoever you're sourcing the metal, and if the metal price increases, he's not going to be like, you know what, you can take the metal and not pay me the increased price. You can take the whatever the price you were paying earlier. That's not going to happen. If the metal price increases from 160 to 270, you have to pay that 270 rupees and get that whatever the ton of metal it is there. You have to get that. Guy is not going to give you a concession, right? And similarly, there are certain companies which will not be able to pass on this price hike to their end customer also. It becomes very difficult. This is what happened in the tire industry also in the year 2022. As a result, what happens, since they don't have bargaining power even with their suppliers, and it is very difficult to pass on the price to their customer, they have a very low bargaining power. And of course, with any industry, there is competition also. Of course, here also there are competition. And the next thing is your constant regulatory changes. You all are aware, right? The entire vehicle industry goes through constant changes, whether it is, you would have seen right now, we are in the tractors and other, this high tractors, especially you're seeing that BS3 to BS4 ka changes jo ho raha hai. So all of these constant regulatory changes, they have to keep changing their inventory, keep abiding by the rules. And of course, right, they have to have an in-house research and development team so they can make the new products and everything. As a result of all of these things, right, and of course, at the end of the day, whatever I explained to you right now in a simple way is nothing but Porter's five forces. Porter's five forces kya hote hai? Wahi competition, supplier, customer, and everything. As a result here, because of Porter's five forces isn't that strong here, what happens is, at the end of the day, because of all these factors combined, you would see most of these companies in this industry, in the auto ancillary industry, end up having low ROE and low operating margin. I mean, again, low ROE and low operating margin as a result of this. It is very rare that you see few companies having, extremely high ROE, ROE to the north of 20% and operating margin to the north of 20%. It becomes hard because of all of these reasons combined. So I hope this is clear as how auto ancillary industry is completely different from the auto industry, right? Now, let's get back to RACL Geartech. So like I told you, RSTL Geartech makes gears primarily, right? That's one thing. And you all know what gear does, right? I don't want to go into like deep into that, like, oh, what gear does and how it is, how it works, right? So that's one thing. So second thing is what makes RSCL business model so unique, right? Like compared to other people. So here in RSCL Geartech, yeah. So right, for to make this, a gear is the end product at the end of the day you're making. So you, to make this gears, first what you'll do, you'll source a raw metal, and then you're gonna get a metal ore. You have to give the shape to the raw metal, shape to this metal that you have. So this how do I try to explain this? So to make this gears, there is a process called forging. Now, what is forging? Whatever the metal is there, you have to give it a shape by using heat, high heat, or using a force. So to give this is known as forging. Now, what happens is usually all of these forging units for many companies are outsourced. They give this forging work to somebody else, and they get it. What happened to RACL was, even they used to do that only even earlier. I think before 2010 or 2011, they used to do this. They used to outsource their forging. But since the number of forging units that they needed were very small, most of the suppliers, the forging suppliers, were not willing to take up their order. Right? I remember Guru Sharan Singh Ji, the promoter of the company, talking about this in one of the con call. They had probably like 2,000 units to get forged, and one of the big two-wheeler or somebody, they were not willing to do it for them. As a result, what they did was they started setting up a forging plant like a small forging plant in their own plant, and they started having a backward integration. This is a unique point here in the entire business model. The fact that they have their own forging plant and they can do a backward integration, this makes it so unique. I'll just show you this small snippet that what a forging is. I got it from the promoter of the company. He shared it on Twitter. So can you see ek garam loha hota hai? You're going to like heat that metal and put this force here. Can you see this downward force? And you're going to shape it into a desired shape that you need. So this is the entire process is called forging, right? And of course, since you are making it in-house, since because of all of this, making it in-house and backward integration, you're going to be saving up on your cost or your raw material cost. So yeah, now let's just do the revenue breakup. If you see the revenue breakup, 65% as of Q4 FY23, 65% is coming from export and 35% is coming from domestic, right? Now, who are their customers? Of course, these people make gears. As you can see, they make gears for all kind of vehicles, whether it is off-road vehicles or whether it is off-road vehicles, cars, trucks, industries, everything, they're making it. But the main primary category here is they cater to premium luxury segment. Premium luxury segment in the sense like BMW, Porsche, KTM, TVS. These are their customers, and they cater to all these things. All these how do I tell you? All these other. Sorry, all these customers. Anyways, now here's the thing. What is another thing? Another important thing to note down here is, right, the fact that you would have seen in 2022, right, because of the war, the Russia-Ukraine war, and of course you would have heard over and over again about inflation and raw material costs going up, right? You would have heard all about it in 2022, right? None of this impacted RACL Geartech. None of this impacted RACL Geartech because the customers who were catering, who they were catering to, first of all, catered to the premium luxury segment to whom inflation was not an issue. The second thing also was the fact that the customers are global. It is not concentrated only to Europe, right? If you talk about BMW is there, throughout the world. As a result, because of this, they didn't face a lot of heat. That is one thing. The third thing is, you might ask me like, oh, Prerna, so at the end of the day, if you're telling RACL supplies these gears and gears and other gears to BMW and other things, are they the only customer? No. No, they're not the only customer. The reason here is because, see, if they take on, like, let's say they are getting maybe 20% of the sales from their revenue today from BMW. I'm just taking an example, right? So let's say they do that, and let's say the portion of orders coming from that increases. And because of that, the incremental revenue dependence on this particular company will increase. What will happen because of that is, let's say if because of that, what will happen if the incremental dependence increases on one company? As a result, what happens if, let's say, that company goes into like a downturn, right? Something happens to that company. What will happen? Even these people will face a burden, right? As a result, because of this, they make sure that no customer is more than 20 to 25% of their revenue. Like, that is one thing they make sure, right? And another thing I would like to highlight here is, if you can see, right, you can see the percentage of revenue that is coming from each segment. You would have seen in the early in 2021 and 2022 that three-wheeler market was a dying market, right? As a result, what happened? They started, like, their dependence on this three-wheeler, they started reducing it from 7 to 6 to 4. You can see that, right? It has been reducing consistently, and they shifted from there to the passenger vehicle. Can you see here the four-wheeler market? And that has been increasing. Not only that, in the EV segment, and also in the EV segment also, they've been trying to increase. So this is one thing I like. Another thing about the company is the fact that they're very adaptable, and they're adaptable to the changes. They understood that, the three-wheeler market, it is not going anywhere. It is really stuck, and they tried, and there was a lot of demand. If you would have seen, right, as we were coming out of COVID, and the trend was more towards the SUV vehicles. You would have seen the waiting time for Kia was 6 months. Mahindra XUV that came, the Mahindra XUV and everything, that saw a huge boost. And even Maruti also started coming up with new models, such as, I forgot the name, but anyways. So as a result, what happened? They shifted, and they started moving into passenger vehicles. So this is one thing I really love about their business model. When they understood it, they changed their dependency from there and moved to where there was an increasing demand. Right. Now here's the thing. Of course, right. Yeah. So here's the thing. So what another thing about this business model is, as you all know, if this business model has a high operating margin of 25%, right? Like, to the north of 25% they have. So if this is the case, of course, you might be wondering, oh, okay, Prerna, if this business is doing so well, can't another competitor come? What is the threat of this business, right? All of these things. So let us discuss that. What can be the possible threat, and why does this industry in general have a high barrier to entry? Like, why does this industry in general have high barrier to entry? Now, if you focus here, can you just focus my cursor? This is the entire process that goes through if you have to acquire a client. If you have to acquire a client or a new business or the entire process, that is, this is the thing. RFQ is received from request for quotation. The entire thing from request for quotation to the ramp to production, the entire thing takes 9 to 12 months. Now, what is this request for quotation? Let's, for example, again, just an example. Let's say BMW is coming to RACL Geartech, and they're like, hey, listen, I want to know what are the kind of gears you do, different types of gears you do, and how much is it costing per gear, or per ton of gear, so and so. Give me the quotation. In simple ways, if I have to example, it's like you're going to Zara, and you're not buying anything, but you're seeing, like, if this cloth, what is wrong with me? This cloth is going to suit you or not. It's the same. I mean, that's the easiest way that I can put up request for quotation. So request of quotation is nothing but inquiring about the product. आप कौन सा product बनाते हो, उसका cost क्या है, all of those things. From there, from just asking to that product to the entire, that is the request, ramp to production. Ramp to production is what you've gotten the order, you've gotten the green signal to go into production and start producing. This entire process takes 9 to 12 months, right? So it is a very, like, lot of time and lot of gestation period is there. That's one thing. The second thing is the fact that this is an auto ancillary product, right? It goes into the vehicle, so safety becomes very crucial, right? Now, when you talk about safety, of course, all of these products have to get regulated, right? I mean, they have to get certain kind of licensing, or they have to get approved by any kind of regulatory or the authority body. Because let's say if I am an auto company, why would I want to buy a product from somebody who doesn't have any regulatory, right? And I have to spend, again, a shit ton of money in, like, just trying to see if this product is of great quality. So I would rather buy something that already passes through the regulatory boards. So as a result, when you combine both of these things, it becomes very capital intensive. The entire process is extremely capital intensive. As a result, because of this, the fact that the initial setup cost for this industry can be so high, there is very, the threat is, I wouldn't say there is no threat, but the threat is very minimal, and the competition is also very minimal. So that's the thing. The second thing is the inventory management. You would have heard me, right? If you would have seen my earlier videos, I keep talking about whenever it is a sandwich business model, you would see that the inventory days being high is not an issue. Whether the inventory days being high, or you would see that the inventories are increasing in the balance sheet, it is not an issue. Why is that so? Now see, let's say now BMW is already my customer, okay? Now, if he wants to place another order, now he's already my client, he's gone through the whole process, he wants to place an order for me. He's not going to wait for it, right? He's going to be like, oh, listen, I need this so and so product in the next 3 months, or let's say, in the next 3 months or so. Now you understand that you're making such a complex product like gas. It can't be made in 3 months. You have to first of all to source the entire raw material only. It takes 3 months. So what they do is, I'll just try to explain the entire planning cycle. How do they plan this inventory? अगर आप देखते हो पहले what they do is they see the customer requirements. Like what could be the requirement, and they what could be the requirement. And they just forecast it, and they make a sale plan. After that, what they do, the first of every month or the 18th of every month, what they do is they decide like, okay, they do a forecasting in like this, in the next 6 months, so and so products are required, blah blah blah, everything is required, right? Everything is required. And then they send the sale plan to their plant, and they check if the raw materials are available or not, right? If the raw materials are not available with once the sale plan is sent, what they do, they have to place an order, right? Then the order is getting placed. Like I told you, to source your raw material, it takes 3 months, right? 3 months it has to be sourced before dispatched. And then after that, you have to it has to go through the whole process of making the gear, and then you send it to the dispatch, and then it reaches the customer. So you do realize, right? Uh, if the customer wants the product in 3 months, but it takes more than 3 months to make the product, as a result, what you have to keep a lot of things in inventory. And that is why you see in many of the auto ancillary companies, whether it is tires, whether it is this, the inventory days are high. That is why you see the inventory also. If you can see in the balance sheet, you will always see that the inventory will be high, and as the company projects more growth, as the growth increases, the inventory days will be high, right? And as a result, because of this, you'll see the receivable day, the payable day, and the working capital changes also being high because of this reason. The fact, uh, again, like I explained you, because of this process. Now, see, you can be like, oh, why are they keeping all of this inventory? Because see, if I'm a company, I'll need a product in 3 months. I'm not going to wait for you. I will need the data and the product in 3 months or not. If you can, you do it. Otherwise, what will happen? The company will go to some other auto ancillary company, right? And they'll be like, hey, give it to me, because the time becomes very crucial here. So as a result, now you understand why the inventory is as the growth rate increases, why even the inventory can increase, and why it is not an issue. That's one thing. So that is entirely about the business model, what the company does, and how the whole operation takes place and everything. That is a business model. Now let's start with the outlook and the management commentary, right? This is again taken from the con calls. And how has the Q4 result season been, right? So I've been tracking this company for over more than a year. But when I started tracking the company, right, they told that they earlier they were making, I think this is 2023, right? In 2022, they had 271 crores of revenue, and they had given a plan. I think the quarter before that, they had given a plan that they want to reach 500 crores of revenue by FY25. So if you take 271 to 500, it is around 20 to 22% CAGR. And of course, if you take from like right now, if you have seen over the last 1 year the operations that the company has done, the management has really walked the talk, right? They have increased the revenue by 100 crores this year. So it has become from 271 to 371 crores. And now if you calculate 371 to 500 in the next 2 years, it is 18% CAGR, right? So how does this company plan? Like that is the goal plan. They want to reach 500 crores of revenue by FY25, right? So how will this 500 crores of revenue be reached, right? The first thing is ZF, which is one of their customer. ZF is now a German company. I can't pronounce the name. Please Google it. It's very hard. So ZF is one of their customers. So what happened? ZF right now, they outsource around 300 million worth of projects to India, right? And of course, RACL is one of their customers, right? I'm not telling they get all the 300 million orders, but you do realize RACL is one of the customers. Going forward, the projection is that ZF will outsource around 1 billion worth of project to India. Even if RACL gets 10% of it, you understand what a big deal it is. And ZF is already their customer from the last 1 year, and the relationship with them is nothing but improving and deepening, right? That's one thing, right? The second thing is, of course, this has over the years, if you've seen, they have the highest operating margin for any auto ancillary industry. Now, why is that? So why is that the company has the highest operating margin? Because their product is very unique, and like I told you, they're making gears. It is a unique and high-end complex product. Because of that, and not everybody can make it, and because of that, the operating margin is 25%. So what has been the updates? The business updates in Q4. One is, of course, they signed an order from Aprila, I think. Yeah, backed an order for transmission sub-assembly from Aprilia. So Aprilia is a two-wheeler company based out of Italy, and they do the 660 cc of motorcycle. So they backed an order from that. And the second thing is, I would like to highlight this first line. Backed an order from European two-wheeler for supplying forging yokes. So as of now, like I told you, remember the unique point of RACL Geartech, they were doing this backward integration for themselves. As of now, they were doing until now only for their own company. They were doing the whole forging process. Now what they're doing is, without having any value addition product, trying to sell the forging, and that is their another stream of revenue that they're adding, because the opportunities that are coming to India for the forging manufacturing is very high, right? And that is also another line. The second thing is, this company that is there earlier, they were a part of RACL family for a very long time, but they still didn't give the order for RACL Geartech to do this forging yoke, because they thought they couldn't do this. But finally they have given the order. They trusted, and they've been very satisfied with the kind of service and the product that RACL has done. And going forward, again, since now one of the customer has opened line for another source of product, of course, right, the other customers that are there, even they will do it, right? The second thing is this ZF that is there. That is another thing. ZF, again, the orders from ZF also has increased. As you can see, project volume has peaked 2 years before anticipated projection. So whatever that project they were estimating 2 years ahead of here, they've got that order before that, like 2 years earlier to that only. I'll explain the other three, how do I tell you, the other 3 points with respect to the this one, the capex. Oh, another thing I would like to highlight here is, so recently what has happened, all this auto industry that are there, they're very focused on having, whoever these auto ancillary companies are, they need to get at least, I think, 50% of their power must be generated through solar power and things like that, otherwise they won't give the order. And if you see here at RACL will be using 60% of the renewable energy. They've even like got a green check mark even with that also. Again, exceptional thing. So let us first understand the capex. Okay, so before I go and explain you what is the capex going on in RACL company, first let me tell you, understand how this capex works in an auto ancillary industry. So usually, most of the times, what this auto ancillary industry they do is they do a capex, right? They do a capex, and then they go and get the order, right? As a result, what happens, since these people have already done the capex, the customer knows, oh, this guy has already done the capex, and then what happens, they start to dictate the terms. They be like, oh, I need so and so with this less price. They start to dictate everything, and because of this, the margins can shrink, because they might try to bargain the product that they're doing at a very low cost than the usual rate, right? And of course, the whoever this auto ancillary guy is there, if he has already done the capex, and if he doesn't have order book, what will happen, the entire thing, he will go into debt, the entire thing will go for a downturn. So of course he will bend down and will agree to all these terms. So this is where RACL Geartech is very unique compared to other business models. RACL Geartech does capex only and only once the order is confirmed. That is the only time they go ahead and do the capex. This is very unique thing I've never seen. I've tracked so many auto ancillary companies, you can talk about it, I probably know it, and I've tracked, and I've never come across a capex plan like this. This is the first time I'm seeing, where a capex plan, when once they get the order, then only they go for once the order is completely confirmed, then they go and set up the plant. So this is a very unique, because I still remember the promoter talking about it, why they're doing that, and he told that the margins, for me, protecting my margins are very important, than anything else, and that is why they go through this. So they have 3 warehouses in Europe, as you know, because, oh my god. Oh yeah, it's recording. Thank God. So as you know, there are 3 warehouses in Europe, because the majority of the customers are coming from Europe, right? So they have 3 warehouses to make the whole logistics ease. And other than that, they have one plant here at Gajurala. They have one plant at Gajurala, which is their mother plant. And like I told you, there is this new order I told you, right? They got it from ZF. So how do I tell, to do the ZF order, what happened, they, in the Gajurala plant only, they set up another plant called Ojas plant. I think that's the name, Ojas plant. And this plant, they started the capex in 2021 or 2022. They started the capex, and it has commenced in March 23. It has commenced, and it has gone into 95% utilization already. So here's the thing, why this is again an impressive part, because when you set up an auto ancillary company ka plant, it can't go into 95%, 100% utilization in just like 1 quarter, or the moment it started. It's very rare you come across an auto ancillary plant that goes into 40% at first and 60%, right? And then maybe in 2 years it reaches 100% capacity utilization. The fact that these people just started the plant in March 2020, in March, and already it is into 95% utilization, it is brilliant, right? That is one thing, right? And this is a plant that they built only for that one customer called ZF. So the dedicated plant for ZF, that is OGIS, which they started the Capex in 2020 and commenced in 2023. Right now that has gone into full production and it is at 95% capacity utilization. And another thing is that this is still not enough for them, and again it needs to run at 120 to 130% capacity utilization. And remember, in the business update also they were talking about the business projected volume, right, which the customer gave. They were supposed to do, like, probably it was supposed to happen after 2 years. It is already peaked, and the projections are happening currently as of now too. That's one thing. The second thing is they have another plant called Shakti plant. For the Shakti plant, again, the Capex is done, everything is done, the commercial production has started, and it will start showing up in the revenue in Q3 FY24. So this is the Shakti plant. How do I tell you the outlook or the image that you can see? One more interesting thing I would like to highlight here is I got this from the promoter's Twitter handle, right? You would have seen this is a new plant. This is a picture of the new plant, the fully commissioned plant OGIS. Remember, I talked about the plant that is running at 95% capacity utilization, and it is still not enough, and it has to run at 120 to 130%. And this is a new plant. Can you see how new and posh it looks? Now look at this. One second. Yeah, this is the plant that has been running since 1987. Yeah, the Chetak plant at Gajrala, which is their mother plant. Can you see here? It is looking as new, right? Like, you can see that how well the company has been maintaining its plants. Otherwise, you can, like, it just shows the company is like they're maintaining the plants well. Probably then they don't have to spend a lot in maintenance cost also going forward. Anyways, again, so that's one thing. So you can see that there is growth, there is demand, and the company is investing heavily in Capex. Again, clearing another point of checklist. Now let's just go to the what is that? The Q4 FY23 numbers and just check how the company has been doing. This is standalone. Let's just go for the consolidated one. Consolidated. Yeah. You would have seen in consolidated here. Can you see here that the revenue has increased 32% year on year, and the PAT has increased 94% year on year. Other income, again, majority is coming from revenue from operations, not from other income. You would have seen here that the quarter on quarter, the revenue has declined, right? Now, here's the thing. The reason for quarter on quarter revenue being declined is RACL Geartech supplies gears for this industry called ATV, or you can tell it as what do you tell the off-road vehicles basically. So these off-road vehicles are usually the sales are high during summer. Like, so if the sales are high in summer, the production has to go in winter. So as a result, Q3 becomes their seasonally high, like the best season for them. So there is a seasonality in the business a little bit because of this Q3 being their extremely high season, like bell season. Q4 is a bit lower. As a result, it is just because of the seasonality. You see that the quarter on quarter, the results have been, the revenue has been down. Other than that, if you see year-on-year comparison, the year-on-year, you would have seen that revenue has increased by 32%. Profits have increased by, I think, 94%. PAT margins also has improved, and PAT margin is at 10%. Employee benefit cost, if you see, again, has increased on a year-on-year basis. So has other income, right? So all good. One second. If you see, there is no asset liability mismatch also. If you check the current asset by current liability also from 440, is it in lakhs? Yeah. Where is this? Current asset is 198 crores and current liability is 173. It is still greater than 1. So good thing, right? One thing I would like to highlight here is you would see, like I told you, auto ancillary industry, right? It can't run without debt. You know how hectic, like I just explained you, because of the inventory management, the sandwich business model, right? Debt becomes a crucial part of it. If you see here, the debt has increased, right? And I think the debt has increased by 23%, right? On a year-on-year basis, debt has increased by 23%. Here, before you can come and tell it, be like, oh my God, debt has increased by 23%. Earlier, it had been increased by 50%. Calm your high horses down. First thing first, debt is not a bad thing. If I'm able to use the debt as an investor, maybe yes, debt can be a bad thing for certain companies, but you're running a business here, right? Debt is not a bad thing unless and until I can use and resource the debt into useful ways, right? So here's the thing. My company is not my company, but yeah, the company, the company is increasing the revenue by 30% on a year-on-year basis. The asset turnover has improved, right? The asset turnover has improved. There's profitability in the business, and in spite of all this, they're increasing. They have to. There is a lot of demand because of that. They're investing in capex. इसके वजह से तो debt बढ़ेगा ही, right? In spite of this debt increasing by 23%, you will see that the equity, that debt to equity ratio is less than 1.5. I think it is 1.2 or 1.3 as per, I think the last time I calculated it was 1.2 or 1.3. So debt to equity is 1.2 or 1.3. I don't see why people start panicking about debt being increased. Another thing also I would like to highlight is the net increase in debt. If you see, compared to last year, the increase in debt to this year, the increase in debt, the net increase in debt has dropped by 50%, right? So as a result, you know that the company is paying the loan at a faster rate than that it is taking. So the repayment of loan is at way faster rate. So before you can come at me like, oh my God, that has been increasing. Listen, asset, like, I'm going to reiterate this. Asset turnover has increased. My revenue from operation has increased by 30%. It has been profitable. Capex is there. Demand is there. As a result, all of these things, because of this, again, if I'm taking that, I have no problem. Another thing also, I would like to connect it with the ROE angle, right? If I have to compare it with the ROE angle, I think even the book value has increased, right? 131 to 167 by what, 30%? Where have I written it? Yeah, book value also has increased by 27.4%, right? Now the ROE. ROE is what? Net income divided by equity. Now there are three components for ROE, right? One is asset turnover, one is profit margin, and the other one is your financial leverage, right? Asset turnover also, as I told you, it has also increased. I think it has increased. Asset turnover has increased by 30%. The second thing is profit margin. You will see that the profit margin is also high here. Like I told you, even this is the only auto ancillary industry that has an operating margin of 25%. Your profit margin is also there. The financial leverage that comes, the leverage comes from debt. Because of that, you would see a part of ROE also has increased. The ROE has increased from 19 to 24%. Earlier, when you were talking about, I understand earlier, the ROE was, I think a year back, when you talk about 2022, the ROE was around 16 to 18%. I think in that range, the ROE was in that range. So at that time, if you had told me like, okay, listen, the debt, keeping that ROE, like if you had that 16 to 18% ROE and the debt kept adding on, I understand it becomes an issue, right? Because if you're talking about a 16% to 18% ROE and you're targeting a growth of 25% on a year-on-year basis, then it means what? To get that extra incremental growth, you have to either dilute your equity or you have to take a debt. But that's not the case here, right? Because you've seen the ROE being improved because of what? Because on all three parameters, if you see, all three parameters of ROE, if you see, it has improved, right? Asset turnover, profit margin, and financial leverage. As a result, you would have seen, again, because of that, the ROE has increased again. Nothing wrong with it. Then the other thing is, let me just explain the cash flow also. If you see, the cash flows has also increased here from 32.9 crores to 51.4, right? After considering all the depreciation cost and everything, it has still increased. Before the working capital change, you'll see an increase of 30%. Then later, if I have to see here the receivables, payables also not a huge increase, hardly any. Yeah, after all the how do I tell you, after all your working capital changes also, and earlier, can you see here the increase or decrease in receivables? Can you see here it has improved? Earlier it used to be 21.7 crores, here it is 7.57 crores, which means what? The relationship with, yeah, which means what? The relationship with your customers is becoming better, right? Earlier, 21.7 crores were not coming to the company. Now, the rate has decreased and it is only 7 crores that is not coming to the company. So you can see even the receivable has increased. Sorry, receivable has become better, right? If you see, after all the working capital changes also, the net cash generated from operations, right? After all of this has increased from 10 crores to 60 crores, right? It's a 6x. After this, you see, where is this 60 crores is going, right? If you see, the majority from this 60 crores, it is literally going 61 crores is going to purchase of plant property or equipment. Now, purchase of plant property of equipment, like I told you, right? In the last 2 years, they've done a lot of capex. I think in the last year, that is in 2022, the capex was 345 crores, and the year before that was around I think 245 crores. I'm not sure about the numbers. I'll have to recheck it. But as much as I remember, I think, because I've read this con call long back, last year, I don't remember that very clearly. But 245 to 345 crores, and it makes sense, right? Because they set up new plant. One is the Forges plant and the Shakti plant. Now, see, a lot of people might come and again tell like, oh, listen, the free cash flow is negative. Like, why would I need free cash flow in my business? I don't understand the whole point of having a free cash flow positive. My company, this company is very small, right? The company is very small, so and they have huge avenues for growth. So why will they keep cash for themselves? It is better that I take that cash and put it into somewhere other places of revenue so it can grow, right? And for that, if I have to fund a debt, it is great, right? So it is absolutely no problem. So here, like again, other than that, of course, the money is either going, can you see here, into plant property and equipment or in the repayment of debt, right? Like I told you, the repayment of loan has been higher than the rate at which they're taking the loan. That is why you're seeing the net increase in debt has been reduced by 50%. So all in all, that's about RACL Geartech, right? Like I really admire this company, um, to what they do. And the last thing I would like to highlight is the risk. What is the risk that can be associated with this company? One is the geopolitical risk. As you know, these companies are a lot into export, because of war and anything like we've seen last year. If something like that happens, if something like that turns out, not just RACL Geartech, majority of the customers, sorry, the industry that are catering to will also be affected. Having said that, geopolitical risk becomes an issue. The second thing is fluctuation in metal prices. Since their entire product will depend primarily on raw materials, right? I still remember, again, I think the promoter of the company, Guru Sharan Singh ji, I remember him talking about this. I think the price of nickel probably increased from $23,000 per ton to like $108,000 per ton, something like that, in the London Metal Exchange, right? Again, because of all of these things, fluctuation in metal prices, and if they're not able to pass on the cost, margins can be squeezed. Other than these two risks, again, having said that, it is a business will always have risk. Other than these two, I don't see any potential risk here in this company. Having said that, I've tried to cover. Let me just stop presenting. Yeah, having said that, it's a beautiful company. It literally clears all my checklist point, whether it's in growth, path, the operating leverage, the capex, the demand, and of course the best point is the management. I absolutely adore the management. If you ever have a chance, I would tell you, like, how do I tell you, listen to the management one con call, and it's really wonderful, the way they interact with the investors, whether it's even on Twitter, they keep like updating on what they're doing. So yeah, even the management is great. Having said that, so yeah, I've tried to cover all of these points, whether how the debt, whether even in terms of debt, how it is not a big deal here, how ROE has also improved. So again, not a big deal again. So having said that, I hope I've tried to make a justice to this company, and yeah, hope to see you again next time with another business model, another on another day. Yeah. So take care. Have a nice day. Bye bye.